There's a phantom that haunts the stock market. It whispers a seductive promise into the ear of the hopeful, the impatient, and the new. It points to a stock chart that looks like a fallen cliff, a company that has lost 90% of its value, and it says, "This is your chance. This is the bargain of a lifetime. What has fallen so far must surely rise again." This phantom is the architect of the value trap, a financial prison where capital goes to die a slow, agonizing death. It is a siren song that has lured countless investors onto the rocks of financial ruin, and it is the very enemy that Warren Buffett, the most successful investor in history, spent the first half of his career learning to defeat. He learned a fundamental truth, a lesson forged in the fires of his own costly mistakes. It is far better to buy a wonderful company at a fair price than a fair company at a wonderful price. And it is an act of financial suicide to buy a broken company at any price, hoping for a miracle. The most dangerous words in an investor's vocabulary are, quote, turnaround. Because, as Buffett would come to realize, turnarounds seldom turn. This is the story of that realization. It is the story of a shift in thinking so profound it transformed a clever stock picker into a legendary builder of wealth. It is a journey from the statistical scrap heap to the pinnacle of quality, and understanding this journey will provide you with the single most powerful weapon you can possess in your quest for financial freedom: the ability to distinguish a true bargain from a fatal trap. This principle is the final promise that separates fleeting luck from sustainable, generational wealth. Our story begins not in the gleaming towers of Wall Street, but in the decaying heart of the American textile industry. It is the early 1960s, a time when the looms of New England that once wove the fabric of a nation were falling silent one by one, succumbing to cheaper labor overseas and the relentless march of technological progress. This is the world that a young Warren Buffett, a devout disciple of his mentor Benjamin Graham, saw not as a graveyard of industry, but as a hunting ground for bargains. Graham had taught him the art of cigar butt investing. The idea was simple, quantitative, and deeply appealing. You walk down the street and you see a disgusting, half-smoked cigar butt lying in the gutter. It's not pretty, it's not something you'd want to own forever, but it has one free puff left in it. You pick it up, take that final puff and throw it away. In investing terms, this meant finding companies trading for less than their net working capital. You could theoretically liquidate the company, sell off its inventory and accounts receivable, pay off all its debts, and still walk away with more cash than you paid for the stock. The quality of the business, its long-term prospects, its management, none of that mattered. It was a purely statistical game of buying dollars for 50 cents. And in 1962, Buffett found what he thought was the perfect cigar butt, a struggling textile manufacturer in New Bedford, Massachusetts, named Berkshire Hathaway. The company was a shadow of its former self. It was closing mills, laying off workers, and fighting for survival in a dying industry. But the numbers, to a Grahamite, looked irresistible. The stock was trading at $7.50 per share, while its working capital per share, the cash, inventory, and receivables minus all liabilities, was over $11. It was a classic cigar butt, with plenty of puff left in it. Buffett began buying the stock for his investment partnership. He wasn't looking to own it forever. He was looking for that last puff. The company was periodically closing mills and using the proceeds to buy back its own stock. Buffett's plan was to simply accumulate shares and then tender them back to the company's management, led by a man named Seabury Stanton, at a small profit. It was a simple, unemotional financial transaction. In 1964, Stanton made a verbal offer to Buffett to buy his shares back for $11.50 each. Buffett agreed. It was a tidy profit, the cigar butt strategy working to perfection. But when the official written offer arrived, the price was not 11.5. It was 11 3/8. Stanton had tried to chisel him for an eighth of a point, a mere 12.5 cents per share. This is the moment where the story turns from a lesson in finance to a lesson in human psychology. Buffett, by his own admission, was enraged. He felt cheated, betrayed. The cold, calculating investor was overtaken by a hot flush of anger, and in that moment, he made a decision that would become both the biggest mistake of his career and the foundation of his greatest success. Instead of selling his shares and walking away, he decided to fight. He went on the offensive, aggressively buying up every share of Berkshire Hathaway he could find. He launched a takeover bid, and by 1965, he had won control of the company. Warren Buffett, the brilliant young investor, was now the proud owner of a failing textile mill in a dying industry. His ego had overridden his investment logic, and for the next 20 years he would live with the consequences. He had bought the cigar butt, but now, instead of throwing it away, he had to run it. He poured money into the business, trying to turn it around. He bought new equipment, streamlined operations, and hired the best managers he could find. He was determined to make it work, to prove that his decision had not been a mistake. Every year, the management team would come to him with proposals for more capital expenditures, more machinery, more investment to stay competitive against rivals who had cheaper labor and newer factories. And every year Buffett would approve the spending. He was pouring good money after bad, throwing it into a bottomless pit of terrible economics. The textile industry was a commodity business of the worst kind. The product, plain woven cloth, was undifferentiated. The only way to compete was on price. This meant a constant, brutal downward pressure on profits. For 2 decades, Berkshire Hathaway's textile operations bled capital. The business consumed vast amounts of cash just to tread water, and it never generated a meaningful or lasting return. Every dollar that went into a new loom was a dollar that could not be invested in a wonderful business. It was a boat anchor, a massive drag on what could have been. In 1985, after 20 years of struggle, Buffett finally surrendered to the inevitable. He closed the last textile mill. The cigar butt had finally burned down to his fingertips, and the burn was a lesson he would never forget. The deep psychological principle at play here, the force that trapped a genius like Buffett for 2 decades, is a powerful cognitive trap known as commitment and consistency bias. Our brains are wired to value consistency. Once we have made a public decision or committed to a course of action, we feel an intense internal and external pressure to stick with it, to behave consistently with that earlier decision. Buffett had publicly taken over Berkshire Hathaway. He had committed his partnership's capital. To admit failure, to sell it off early, would have been to admit that his initial, anger-fueled decision was a colossal error. His mind, like all of our minds, fought against that conclusion. Instead, it sought to justify the initial decision by doubling down, by investing more time, more effort, and more money. This is the very same reason why people stay in bad jobs, bad relationships, or continue with failing projects. The initial commitment becomes a psychological trap. Closely related to this is the sunk cost fallacy. This is the irrational belief that you must continue a venture because of the resources you have already invested, the sunk costs, even when all objective evidence suggests that cutting your losses is the best course of action. Every dollar Buffett put into the textile mills was a sunk cost. Rationally, the decision to invest another dollar should only have been based on the future expected return of that dollar, but emotionally it was impossible to ignore the millions that had already been spent. The feeling is, I've already come this far, I can't quit now. The mind tricks us into believing that more investment will somehow rescue the initial investment, when in reality it's often just digging the hole deeper. Buffett himself would later describe this as throwing good money after bad. He was trying to rescue a decision that was flawed from the very beginning, a decision born of emotion rather than the cold logic he so famously espoused. So how can we, as retail investors, as entrepreneurs, as decision-makers, avoid this trap? We need an applied mental model, a blueprint that short-circuits these biases before they can take hold. The model is an extension of Buffett's famous circle of competence, but applied specifically to business and industry structures. Before you even look at the price of a stock, before you even read the annual report of a specific company, you must first analyze the industry in which it operates. You must ask one simple, brutal question: is this a good business to be in? This blueprint has 3 steps. Step 1. Analyze the industry's long-term prospects. Is the pie growing or is it shrinking? In the 1960s, the American textile industry was a dramatically shrinking pie. It doesn't matter if you have the best buggy whip company in the world if the automobile has already been invented. Investing in a shrinking industry means you have to be a brilliant manager just to tread water. Investing in a growing industry, a tailwind industry, means you can be an average manager and still achieve fantastic results. Step 2. Analyze the competitive landscape. Is this a brutal commodity business where the only differentiator is price? Or is it an industry where companies can differentiate through brand, service, or technology? The textile business was a commodity. The airline industry is largely a commodity. Most raw material businesses are commodities. These are industries characterized by vicious price wars, low margins, and terrible returns on capital. You want to look for industries where companies have pricing power, where customers make decisions based on factors other than just who is cheapest. Step 3. Only after an industry has passed these first 2 tests should you even begin to look at individual companies within it. This simple 3-step process acts as a filter. It prevents you from ever being seduced by the statistical cheapness of a company in a terrible industry. It would have saved Buffett from the Berkshire Hathaway textile mill entirely. He would have analyzed the industry and immediately concluded that no matter how cheap the stock was, it was a bad business in a dying field, a value trap waiting to happen. By focusing on the quality of the playground first, you avoid the temptation to play a losing game. This discipline is what separates the masters from the masses, because the path of the 99% is the complete opposite. It's what I call bargain hunter's blindness. The average retail investor, armed with a stock screener and a desire to get rich quick, does not start with the industry. They start with the price. They screen for stocks that have fallen the most, stocks with the lowest price-to-earnings ratios, stocks trading below their book value. They see a stock that has fallen from $50 to $5 and their eyes light up. They don't see a potentially broken business whose fundamentals have deteriorated. They see a 10-bagger in the making. They think, it's so cheap, it has to go back up. They anchor on the old $50 price and view the current $5 price as a massive discount without ever asking the crucial question, is the underlying business worth even $5? They fall in love with a turnaround story. They read news articles about a new CEO, a new strategic plan, and they mistake hope for a viable investment thesis. They buy the struggling airline because it's cheap, ignoring the fact that the industry has destroyed more capital than it has ever created. They buy the beleaguered retailer because it's a quote-quote household name, ignoring the fact that its customers have all moved online. They are buying the cigar butts, but unlike the young Buffett who planned for one quick puff, they plan to hold it and love it and wait for it to magically transform back into a premium cigar. This is a recipe for disaster. It is the path to a portfolio filled with dead money stocks that go nowhere for years, trapping your capital and destroying your chances of achieving real financial independence. The direct financial connection of this mistake, the real-world cost, is a concept called capital allocation drag. Imagine your investment portfolio as a high-performance engine. Every dollar is a drop of fuel. When you invest in a wonderful, growing business, you are injecting high-octane fuel into that engine. When you invest in a struggling, capital-intensive turnaround, you are pouring sludge into the tank. For 20 years, the Berkshire Hathaway textile mill was sludge. It directly manifested on the company's financial statements as a terrible return on invested capital, or ROIC. ROIC is a simple measure. For every dollar of capital invested in the business, how many cents of profit does it generate each year? A great business might generate 20, 30, or even 50 cents of profit for every dollar invested. The textile mill was lucky to generate a penny or two, and often it lost money. That meant every $1 million Buffett reinvested into new textile equipment was effectively being incinerated. That capital was being dragged down, its potential squandered. More importantly, it created a massive opportunity cost. Every dollar that was tied up in the textile business was a dollar that could not be used for Buffett's true genius, buying wonderful businesses through Berkshire's growing insurance operations. It was a dollar that couldn't buy a piece of See's Candies, or Coca-Cola, or the Washington Post. The financial drag wasn't just the paltry returns of the mill itself, it was the spectacular returns that were foregone. The value trap, the turnaround that never turns, doesn't just fail to make you money. It actively prevents you from investing in the opportunities that will. It is an anchor on your net worth, silently and relentlessly pulling you down, while the great companies of the world sail away over the horizon. The greatest lesson from the textile mill was not just to avoid bad businesses, but to understand that the act of owning them carries a catastrophic, hidden cost, the cost of missing out on the truly great ones. The painful two-decade education in the textile mills was the crucible that prepared Buffett for the most important meeting of his life. It wasn't a meeting with a president or a Wall Street titan. It was the ongoing, decades-long conversation with his friend and partner, Charlie Munger. If Ben Graham taught Buffett how to buy a stock, Charlie Munger taught him how to buy a business. Munger was the catalyst, the intellectual force who completed the transformation of Warren Buffett from a mere cigar butt hunter into the greatest capital allocator the world has ever seen. Munger's philosophy was simple and profound. Forget what you know about buying fair companies at wonderful prices. Instead, buy wonderful companies at fair prices. This subtle shift in language represented a tectonic shift in investment philosophy. It was the key that unlocked the kingdom of compounding. And the first door they walked through together was a humble, family-owned chocolate shop from California, See's Candies. The year was 1972. Blue Chip Stamps, a company controlled by Buffett and Munger, was presented with the opportunity to buy See's Candies. The See family wanted to sell, and the asking price was $30 million. The company was a California institution, famous for its high-quality chocolates and its friendly, black-and-white checkered shops. Buffett looked at the financials. The company had about $8 million in tangible assets, things like factories, stores, and inventory. The See family was asking for a price nearly 4 times that amount. The cigar-butt investor in Buffett was immediately repulsed. Ben Graham would have thrown the proposal in the trash. Why on earth would you pay $30 million for a business with only $8 million of physical stuff? It violated every quantitative rule he had learned. He was ready to walk away. But Charlie Munger stopped him. Munger saw something that wasn't on the balance sheet. He saw a hidden asset of immense value. The brand. He saw the loyalty of the customers who lined up every Christmas and Valentine's Day. He saw the trust that the name See's had built over decades. He saw that customers weren't just buying chocolate, they were buying a feeling, a tradition, a reliable and cherished gift. And because of this, See's had a magical power, the ability to raise its prices year after year without losing customers. Munger argued forcefully that this intangible power was worth paying for. He convinced a skeptical Buffett to reconsider. They went back to the See family and, after some negotiation, agreed to a purchase price of $25 million. Buffett would later admit that he bought it with his stomach in a knot, feeling that he had grossly overpaid. He was still thinking like a man buying a cigar butt, not a man buying a compounding machine. That $25 million purchase has since generated over $2 billion in pre-tax earnings for Berkshire Hathaway, cash that has been sent back to Omaha to be redeployed into other wonderful businesses. It required very little additional capital investment to achieve this growth. See's Candies became the prototype, the living proof of Munger's philosophy. It was the anti-Berkshire textile mill. The textile mill consumed cash. See's Candies gushed cash. The textile mill was a terrible business, bought at a statistically cheap price. See's Candies was a wonderful business, bought at what seemed like a high price. The result was a lesson that reshaped Buffett's entire approach to investing and laid the groundwork for the modern Berkshire Hathaway empire. He had learned that the name on the box was worth far more than the factories that made the contents. The underlying psychological principle that makes a business like See's Candies so valuable is the power of brand loyalty, which taps into several cognitive shortcuts. One of the most powerful is the scarcity heuristic. We tend to place a higher value on things that are scarce or perceived as special. See's doesn't compete by being the cheapest chocolate on the supermarket shelf. It positions itself as a premium product, a special treat, a thoughtful gift. This perception of quality and scarcity allows it to command a higher price. More profoundly, a strong brand acts as a mental shortcut for trust and quality. In a world with overwhelming choice, a trusted brand simplifies decision-making. When a customer buys a box of See's, they are not consciously calculating the cost per ounce versus a Hershey bar. They are buying certainty. They know it will be good. They know the recipient of the gift will be happy. This trust, built over decades of consistent quality and positive experiences, creates a powerful emotional moat around the business. Competitors can replicate the recipes, they can build similar stores, but they cannot replicate the decades of accumulated goodwill and nostalgia stored in the consumer's brain. This is why a customer who has been buying See's for 30 years will happily pay 10% more next year. The price is a secondary consideration to the emotional satisfaction and certainty the purchase provides. Munger and Buffett understood that investing in this psychological loyalty was far more profitable than investing in physical assets. This insight can be translated into a practical, applied mental model for any investor, the pricing power litmus test. It is perhaps the single most important qualitative test you can apply to a potential investment. Before you get lost in a spreadsheet of financial ratios, you must ask one simple, powerful question about the business. If this company were to raise the price of its single most important product or service by 10% tomorrow, would it lose a significant number of customers to a competitor? Step 1 is to ask this question. If the answer is yes, you are almost certainly looking at a commodity-type business. If a gas station raises its price by 10%, its customers will just drive across the street. If a steel mill raises its price, its customers will find another supplier. If the answer is no, you have likely found a business with a durable competitive advantage, a moat. Step 2 is to investigate the source of that pricing power. Is it a powerful brand like See's or Coca-Cola? Is it a patent that protects a unique drug? Is it a network effect, like with Visa or Facebook, where the service becomes more valuable as more people use it? Or is it high switching costs, like with the bank that holds your mortgage, or the enterprise software that runs your entire company? Understanding the source of the pricing power is crucial. Step 3 is to evaluate the durability of that power. Will this advantage likely still exist in 10 or 20 years? This simple 3-step mental model forces you to think like a business owner, not a stock speculator. It shifts your focus from the current stock price to the long-term economic characteristics of the underlying enterprise. It is the filter that separates the See's Candies of the world from the Berkshire Hathaway textile mills. The failure to apply this model is the hallmark of the spreadsheet slave, which represents the path of the 99%. This is the investor who is intellectually brilliant but contextually blind. They live and die by their discounted cash flow models and their quantitative screens. They can tell you the price-to-book ratio of a company to 4 decimal places, but they have no feel for the business itself. The spreadsheet slave would have looked at See's Candies in 1972 and arrived at the same initial conclusion as Buffett. It's expensive. Their model would show that the purchase price was far in excess of the tangible book value. They would see the P/E ratio was higher than a cheap cyclical company like a steel mill. They would conclude it was overvalued and move on, feeling smug about their analytical rigor. What they would completely miss is the powerful, unquantifiable asset of the brand. There is no line item on the balance sheet for customer loyalty or pricing power. Therefore, to the spreadsheet slave, it doesn't exist. They will consistently choose the statistically cheap, mediocre business over the statistically expensive, wonderful business. They will buy the struggling steel mill with a P/E of 8 over the dominant software company with a P/E of 30, and then spend the next decade wondering why the steel mill stock has gone nowhere, while the software company's stock has increased tenfold. They win the battle of the spreadsheet but lose the war of wealth creation because they mistake precision for accuracy and forget that the most important qualities of a business often cannot be captured in a financial ratio. The direct financial connection between this philosophy and massive wealth creation lies in understanding the difference between tangible assets and intangible assets, and how they relate to a company's return on capital. See's Candies is a business that required very little capital to grow. Once the brand was established, growth came from opening a few new stores and modest price increases. The company generated enormous amounts of cash relative to the net tangible assets required to run it. Buffett calls this owner earnings, the cash that the business produces that can truly be taken out and used for other things. A business like See's might generate 50 cents or even $1 in owner earnings for every dollar of tangible assets in the business. This is a phenomenal return. Now contrast this with the textile mill. It was a black hole for capital. To generate even a tiny bit of profit, it needed constant, massive reinvestment in new machinery. It might have $100 million in tangible assets, but produce only $1 or $2 million in owner earnings, a pathetic return. The key insight Munger gave Buffett is that the purpose of owning a business is to generate cash that can be used elsewhere. A wonderful business is a fountain of cash. A terrible business is a drain. The expensive price paid for See's was really a bargain because they were buying that fountain of cash. The cheap price paid for the textile mill was a trap because they were buying a capital-draining swamp. The magic happens when you take the cash from the fountain, See's, and use it to buy other fountains. That is the engine of Berkshire Hathaway. It is a system of acquiring wonderful businesses with high returns on capital, taking the excess cash they generate, and buying more wonderful businesses. This is the financial architecture of compounding, and it was a design that would never have been possible if Buffett had remained a simple cigar-butt investor, forever trapped in the world of tangible assets and statistical cheapness. Once Buffett and Munger unlocked the secret of buying wonderful businesses, the next logical question became what, precisely, makes a business wonderful? The answer isn't a simple checklist, but a deep understanding of a concept Buffett would popularize: the economic moat. A moat is a sustainable competitive advantage that protects a business from competitors, much like a moat full of crocodiles protects a castle. It's this protective barrier that allows a company to maintain its profitability and earn high returns on capital for very long periods. A truly wonderful business has a wide and deep moat. And there is no better story to illustrate the power and importance of a moat than Buffett's investment in American Express during the great salad oil scandal. The year was 1963. American Express was a widely respected company, known primarily for its travelers' checks and charge cards, but it also had a lesser-known division involved in warehousing. One of its biggest clients in this division was Allied Crude Vegetable Oil, a company run by a charismatic swindler named Tino DeAngelis. Allied borrowed massive amounts of money from banks using its inventory of salad oil stored in American Express's warehouses as collateral. The only problem was the giant vats of oil were a sham. Most of them were filled with seawater, with only a thin layer of salad oil floating on top. When the fraud was discovered, Allied Crude collapsed, defaulting on loans worth what would be over $1 billion in today's money. Since American Express had certified the inventory, Wall Street panicked. Investors assumed American Express would be on the hook for the entire loss, an amount that would bankrupt the company. The stock price was sliced in half almost overnight. Chaos and fear gripped the market. This was a crisis of epic proportions. The young Warren Buffett, operating his small investment partnership in Omaha, saw the panic but decided to investigate. He didn't just look at the stock chart or read the hysterical headlines. He did what he called scuttlebutt. He went out into the real world to see if the core business, the real engine of American Express, had been damaged. He visited restaurants and hotels. He talked to merchants. He talked to travel agents. And everywhere he went, he asked the same simple questions. Are you still accepting American Express cards? Are people still buying American Express travelers' checks? The answer, universally, was yes. He then went to competing banks and asked them if they were seeing a surge of customers switching away from American Express. They weren't. What Buffett discovered was that the scandal, while a massive blow to one small division, had not remotely dented the public's trust in the American Express brand. The company's core business, its payment network, was completely unharmed. The customers and merchants didn't care about a warehousing issue in New Jersey. They trusted the name American Express to honor its transactions around the globe. This trust, this brand, was the company's moat. It was a massive, intangible asset that Wall Street, in its panic, had completely overlooked. Convinced that the market was irrationally punishing the entire company for the sins of one small part, Buffett made one of the boldest moves of his early career. He invested 40% of his partnership's entire capital into American Express stock. Within a few years, the stock had recovered and then soared, generating a massive profit for his partners. He saw the moat when everyone else just saw the scandal. The powerful psychological principle at work here is the halo effect, coupled with the immense commercial power of trust. The halo effect is a cognitive bias where our overall impression of a person, brand, or company influences our feelings and thoughts about its specific attributes. For decades, American Express had meticulously built a halo of prestige, security, and reliability. When you used an American Express card, it suggested a certain level of affluence and responsibility. This positive halo was so powerful that it created a protective shield around the brand. The disaster in the warehousing division was a specific negative event, but for most consumers it couldn't penetrate the positive halo surrounding the core product. Trust acts as a powerful differentiator and a cognitive shortcut. In the world of finance, trust is everything. Customers trusted that American Express travelers' checks would be accepted anywhere in the world. Merchants trusted that they would get paid for transactions made with an American Express card. This network of trust, built over millions of transactions over many years, is incredibly difficult and expensive for a competitor to replicate. It becomes a deeply ingrained habit for consumers and a vital piece of infrastructure for merchants. Buffett realized that this psychological asset, this web of trust, was the true source of American Express's value, and that the salad oil scandal had not touched it. Wall Street was pricing the company as if its very foundation had cracked, when in reality, only a window in the attic had been broken. To systematically identify companies with these kinds of protective barriers, investors can use a practical mental model, the Four Moats framework. This blueprint helps you categorize and analyze the different types of competitive advantages a business might possess. Step 1 is to look for intangible assets. These are things you can't touch but which have immense value. This includes brands like Coca-Cola, whose name is a global symbol of refreshment. It includes patents, which give a pharmaceutical company a temporary monopoly on a breakthrough drug. And it includes regulatory licenses, which might grant a company the exclusive right to operate in a certain area, like a utility. Step 2 is to identify high switching costs. This occurs when it is expensive, time-consuming, or risky for a customer to switch from one product or service to another. Think about your bank. Moving your direct deposits, automatic bill payments, and mortgage is a massive headache, so you're likely to stick with your current bank even if a competitor offers a slightly better deal. The same is true for enterprise software. A company that runs on Oracle or SAP is not going to rip it out and start over without an incredibly compelling reason. Step 3 is to look for the network effect. This is a powerful moat where the value of a product or service increases for every new user that joins. Facebook is a classic example. Its value comes from the fact that all your friends are already on it. The same is true for credit card networks like Visa and MasterCard. The more merchants that accept Visa, the more valuable it is for consumers to have a Visa card. And the more consumers who have Visa cards, the more essential it is for merchants to accept it. It's a virtuous circle that creates a nearly impenetrable moat. Finally, step 4 is to analyze for cost advantages. This allows a company to sell its product or service cheaper than competitors, while still maintaining similar or better margins. This can come from superior processes like Toyota's famed production system. It can come from a better location, like a quarry that is closer to a major construction market. Or it can come from massive scale, like Walmart or Amazon, which can negotiate better prices from suppliers than any smaller competitor. By systematically running a company through this four-part framework, you can move from a vague feeling that a company is good to a concrete understanding of why it is good and how durable its advantages truly are. The antithesis to this disciplined search for moats is the path of the 99%, which involves chasing fads and growth at any price. This type of investor makes the critical mistake of confusing a hot trend with a durable competitive advantage. They see a company whose revenues are growing at 50% per year, and they pile in, without ever asking if that growth is profitable or protectable. The dot-com bubble of the late 1990s was a masterclass in this folly. Investors bought shares in any company with .com in its name, mesmerized by the story of a new paradigm and explosive revenue growth. Companies like Pets.com and Webvan grew incredibly fast, but they had no moat. They were selling dollar bills for 80 cents, burning through venture capital to acquire customers who had no loyalty and would flee to the next competitor who offered a steeper discount. They had no pricing power, no network effects that mattered, and massive costs. When the capital ran out, they collapsed. More recently, we've seen similar phenomena with story stocks, companies led by charismatic CEOs who sell a grand vision of the future but have no clear path to sustainable profitability. The fad chaser buys the story, not the business. They mistake rapid growth, which is easy, for a good business, which is hard. They pay exorbitant prices for companies with no moat, and when competition inevitably arrives, as it always does in a profitable industry, the high growth evaporates, and their investment collapses. They are buying castles made of sand, and they are always surprised when the tide comes in. The direct financial connection of owning a business with a wide moat is seen most clearly in the stability and quality of its financial statements. Moats manifest as sustainable high margins and predictable earnings. A company with a moat, like a dominant software company with high switching costs, doesn't have to engage in constant price wars. It can price its products based on the value they provide, not on what the weakest competitor is charging. This leads to high and stable gross and operating profit margins. You can look at their income statement over a 10-year period and see that consistency. A company in a commodity business without a moat will have margins that are all over the place, whipsawing up and down with the cycles of the industry. Furthermore, a moat allows for far more predictable earnings growth. Because its position is secure, a moated company can reinvest its profits into sensible projects with a high probability of success, leading to a steady, upward-sloping line of earnings per share. A company without a moat is constantly fighting for its life. Its earnings are volatile and unpredictable. An investor in a moated business can have a high degree of confidence in what the business will look like in 5 or 10 years. An investor in a non-moated business is simply guessing. The moat, therefore, is not just an abstract business school concept, it is a financial shock absorber. It is the structural feature that transforms a company's financial results from a chaotic, unpredictable mess into a smooth, powerful, and relentlessly compounding machine. It is the source code of a truly wonderful business. Even with a full understanding of what a wonderful business looks like, the human mind remains uniquely susceptible to the allure of the opposite, the broken business that appears to be a bargain. The value trap is one of the most powerful and destructive forces in the market, not because of complex financial reasons, but because of simple, deeply ingrained human psychology. We are wired to love a comeback story, to root for the underdog, and to feel clever when we buy something for far less than its former price. These psychological tendencies create a potent cocktail of cognitive biases that can lead even smart investors to make catastrophic decisions. To truly protect ourselves, we must dissect the psychology of the trap itself. Let's imagine a typical investor. We'll call him John. It's 2010, and John has been watching the stock of a once great American company, a legacy retailer like Sears, get decimated. The stock, which once traded at over $100 per share, is now languishing at $10. John is intrigued. He walks through a Sears store and sees the familiar brand names: Kenmore Appliances, Craftsman Tools. These are brands his father and grandfather trusted. He remembers the massive, iconic Sears catalog. To him, Sears is a piece of Americana. His thought process begins, fueled by a series of cognitive errors. It's a household name, he thinks. It's been around for 100 years. It's not just going to disappear. This is the appeal to tradition, the belief that the past guarantees the future. Then he looks at the stock price. It was $100, and now it's $10. That's a 90% discount. It's so cheap. If it just gets back to half its old price, I'll make 5 times my money. This is the first and most powerful bias. Anchoring. John has anchored his perception of value to the old, irrelevant peak price, making the current price seem absurdly cheap, regardless of the underlying business reality. So John buys the stock. He is now committed. His psychological journey deepens. He starts actively seeking out information that supports his decision. He reads a press release about a new CEO with a, quote, turnaround plan. He sees an analyst report that says the company's real estate portfolio alone is worth more than the stock price. This is confirmation bias in action. He eagerly consumes any piece of data that confirms his belief that he has found a hidden gem, while subconsciously dismissing or downplaying the torrent of negative news, plunging same-store sales, crumbling stores, and the relentless rise of Amazon and big-box competitors. Years go by. The stock doesn't go up. It drifts sideways and then starts to fall further. It drops from $10 to $5. John doesn't sell. The sunk cost fallacy kicks in. I've held it this long. He tells himself, I can't sell now and lock in a loss. The turnaround is just around the corner. He falls victim to the narrative fallacy. He has invested not in a business, but in a story, the story of the great American comeback. And our brains are far more compelled by a good story than by a boring set of deteriorating financial statements. Finally, he's trapped by a misunderstanding of mean reversion. In statistics, mean reversion is the tendency for data points to move toward the average over time. Investors misapply this concept to believe that a stock's price or a company's valuation multiple will always revert to its historical average. But this only works if the underlying business has not been fundamentally and permanently impaired. John believes Sears is just in a cyclical downturn, when in reality it is in a terminal decline. The mean it is reverting to is not its glorious past, but its intrinsic value, which, as it turns out, is zero. John's journey is the classic anatomy of a value trap investor. He was seduced by a cheap price and a good story, and his own brain's biases conspired to keep him trapped in a failing investment all the way to bankruptcy. To combat this powerful cocktail of biases, we need an equally powerful mental tool, a psychological circuit breaker. One of the most effective is a technique developed by the psychologist Gary Klein called the pre-mortem. It is a systematic way to force pessimism and critical thinking into a decision-making process that is often dominated by optimism and confirmation bias. Here is the blueprint for applying it to an investment. Step 1. Before you buy a single share of that tempting turnaround stock, you gather your investment thesis, and then you project yourself forward in time. Imagine it is 1 year from today, and your investment has been an unmitigated disaster. The stock is down another 50%, and it's clear you made a terrible mistake. Step 2. Now from that future perspective, you write a detailed, honest story of what went wrong. Don't just say the stock went down. Be specific. Why did it fail? Did the new CEO's plan prove to be ineffective? Did the company's debt burden become unmanageable as interest rates rose? Did their top competitors launch a price war that destroyed their margins? Did they have to issue a massive amount of new stock just to stay solvent, diluting your ownership stake into near worthlessness? Was the valuable real estate actually composed of undesirable properties in dying shopping malls that nobody wanted to buy? Write down every plausible reason for the failure. Step 3. Now return to the present and critically analyze the pre-mortem story you just wrote. How likely are these negative events to occur? What evidence exists today that supports this failure scenario? This exercise does something magical. It systematically forces you to confront the risks and the bear case for the investment. It breaks the spell of the seductive comeback narrative and allows you to see the situation with clear eyes. It replaces the emotional, hopeful question of what could go right with the rational, risk-managing question of what could go wrong. For many potential value traps, a thorough pre-mortem will reveal that the path to failure is far wider and more probable than the narrow, treacherous path to success. The failure to perform this kind of rigorous skeptical analysis is what defines the antithesis approach, hope as a strategy. This is the core operating system of the 99% of investors caught in value traps. They are not investing based on the current financial reality or a sober assessment of probabilities. They are making a bet on hope. They hope a new management team will work miracles. They hope an entire industry's economics will magically reverse. They hope that the past glory will somehow be reincarnated. In doing so, they make a fundamental error in risk assessment. They confuse a low price with low risk. A stock that has fallen 90% feels safer than a stock at an all-time high. But the reality is often the exact opposite. A high-quality, growing business at an all-time high may have very low fundamental risk, as its success is a proven reality. A broken business at a 52-week low is one of the riskiest assets you can own, because its path is uncertain and its ultimate value may very well be zero. The risk is not the volatility of the stock price. The risk is the possibility of a permanent loss of capital. By substituting hope for analysis, the value trap investor buys lottery tickets disguised as stocks. They are drawn to the high potential payout if it just goes back up, while completely ignoring the overwhelmingly high probability that it will not. This strategy is a slow and painful way to go broke, a portfolio built not on the solid ground of business reality, but on the flimsy, shifting sands of wishful thinking. The direct financial connection, the way this plays out on the company's books, is through a brutal process of balance sheet decay and shareholder dilution. A true turnaround is exceptionally rare, because a failing business enters a vicious financial cycle that is almost impossible to escape. First, they burn cash. Their operations are not profitable, so the cash and short-term investments on their balance sheet begin to dwindle. You can watch this happen quarter after quarter. As the cash runs low, they are forced to take on more debt to fund their operations. This increases the liabilities on the balance sheet and adds a growing burden of interest expense on the income statement, making it even harder to become profitable. As their financial position weakens, their credit rating is downgraded, making any new debt they take on even more expensive. This is the debt spiral. At some point, they may be cut off from the debt markets entirely. At this stage, their only hope for survival is to issue new shares of stock. This is called shareholder dilution. They print millions of new shares and sell them to new investors, often at pitifully low prices. This has a devastating effect on existing shareholders, like our fictional John. Even if the business somehow manages to stabilize and its total value stops declining, the value of John's individual share continues to plummet because the corporate pie is being divided into more and more slices. A value trap, therefore, is a direct assault on the equity section of the balance sheet. It's a battle of attrition that the common shareholder almost always loses. The company's assets shrink, its liabilities grow, and the number of shares outstanding explodes. By the time the turnaround is complete, if it ever is, the original shareholders have often been wiped out or diluted into irrelevance. This is the grim financial reality that lurks behind every seductive, cheap-looking stock chart. The final piece of the puzzle, the culmination of Buffett's half-century of learning, is the understanding of why buying quality is not just a safer strategy, but an infinitely more powerful one. It is the realization that the true magic of investing comes not from clever buying and selling, but from harnessing the unstoppable force of a wonderful business compounding its own value over decades. While the turnaround investor is busy trying to resuscitate a corpse, the quality investor is hitching a ride on a rocket ship. This is the shift from playing financial checkers to playing financial chess, thinking not about the next move but about the entire game. And no investment better exemplifies this long-term power than Buffett's purchase of the Washington Post Company. The year was 1973. The stock market was in the midst of a brutal bear market, one of the worst in its history. The mood on Wall Street was pessimistic, even apocalyptic. Amidst this gloom, Buffett was looking for bargains, but by now, his definition of a bargain had been completely reshaped by Munger and the See's Candies experience. He wasn't looking for cigar butts, he was looking for wonderful businesses that had been marked down by the market's irrational fear. He found one in the Washington Post. At the time, the Post was a media powerhouse. It was the dominant newspaper in a major, affluent, and growing metropolitan area. In most cities, the leading newspaper was effectively a local monopoly on print advertising. Businesses had to advertise in the Post to reach the citizens of the nation's capital. This gave it immense pricing power. It was a fantastic business with a deep and wide moat. Furthermore, it was controlled by the Graham family, particularly the brilliant and principled Katharine Graham, a management team that Buffett deeply admired for their integrity and focus on journalistic quality. The company was public, but because of the market crash, its total stock market valuation had fallen to a mere $80 million. Buffett did a quick, back-of-the-envelope calculation and realized that you could have sold off the company's television stations and other assets for more than the entire value of the company, getting the world-class newspaper for free. It was a wonderful business at a truly wonderful price. Between 1973 and 1974, Buffett invested about $11 million, buying up a huge chunk of the company's stock. And then, he did the most important thing. Nothing. He didn't try to tell Katharine Graham how to run the newspaper. He didn't demand a seat on the board. He simply recognized that he had bought a piece of an economic masterpiece run by a master conductor, and his job was to sit back and let the music play. That $11 million investment, held patiently for decades, compounded into a stake worth over $1 billion. It was the ultimate demonstration of the new philosophy: buy a superior business with a durable moat and great management, buy it at a sensible price, and then let the power of compounding do all the heavy lifting. The core psychological principle that unlocks this kind of success is the power of patience and the ability to practice delayed gratification. Our brains are not naturally wired for this. We have an action bias, a tendency to feel that we should be doing something, anything, rather than just sitting still. The hyperactive trader who is constantly buying and selling is scratching this psychological itch. They feel productive. The turnaround investor is also satisfying this urge. They are part of a dramatic story, waiting for the exciting climax. The quality investor, however, must cultivate the temperament to do the hardest thing of all: sit on their hands. Compounding is like planting a tree. The initial work is in selecting the right sapling and the right plot of land. But after that, the growth happens slowly, almost imperceptibly, day by day, year by year. The impatient gardener is always digging up the sapling to see if the roots are growing, and in doing so, kills the tree. The patient gardener trusts the process, waters it occasionally, and lets time work its magic. Buffett's greatest advantage, he often says, is not his intellect, but his temperament. It's the ability to withstand the siren song of market activity and the human desire for quick results. It's the psychological fortitude to let a great business work for you, to let your money multiply not in days or weeks, but over the long, quiet, and ultimately glorious arc of decades. This leads to the final applied mental model, the no decision needed portfolio. The ultimate goal of a quality-focused investor is not to become a brilliant stock picker who is constantly finding new ideas. The goal is to build a collection of businesses so wonderful that you rarely have to make a decision at all. The blueprint is simple, but not easy. Step 1. Identify a small number of businesses that you understand and that possess wide, durable moats and are run by honest and capable management. This is the hard work, the initial research phase. Step 2. Wait patiently for the opportunity to buy these businesses at a fair or even attractive price. These opportunities don't come along every day. They often appear during times of broad market panic, like the 1973-74 bear market, when even the best companies get marked down. Step 3. This is the most crucial and most difficult step. Once you have made your purchase, your default action should be to do nothing for a very, very long time. Your primary job shifts from active investor to vigilant monitor. You are not looking for the next hot stock. You are simply watching your existing businesses to ensure that their moats are not eroding. As long as the competitive advantage remains intact, you hold. This approach dramatically reduces the friction costs of investing, the commissions and taxes that eat away at the returns of an active trader. More importantly, it insulates you from the psychological stress of the market's daily gyrations and allows the eighth wonder of the world, as Einstein called it, compound interest, to work its uninterrupted magic. This patient, long-term approach is the polar opposite of the path taken by the 99%, the hyperactive trader. This individual's portfolio is a whirlwind of activity. Their screen is filled with tickers, charts, and breaking news. They are constantly, quote, doing something. They buy a cheap stock, it goes nowhere for 3 months, they get bored, and they sell it for a small loss to chase a story stock they heard about on TV. That stock goes up for a week and then falls. They sell it and jump into something else. Their portfolio statement is a long list of small trades, a testament to their constant activity. But at the end of the year, after all the commissions, taxes, and whipsawing, they find they have made little to no progress. Often, they have lost money. They are running on a financial treadmill, putting in enormous effort but going nowhere. They never give any single investment the one ingredient it needs most to create true wealth: time. Their portfolio's performance looks like a frantic EKG monitor: up, down, up, down. The quality investor's portfolio, in contrast, should look like a slow, steady, and sometimes boring ascent up the right side of a mountain. The hyperactive trader is focused on the price of the stock. The quality investor is focused on the progress of the business. This fundamental difference in focus is what leads to a vast and ever-widening chasm in their long-term financial results. The direct financial connection that proves the superiority of this approach can be illustrated with the simple but profound mathematics of compounding and return on equity, ROE. ROE tells you how efficiently a company is generating profits from the money shareholders have invested. Let's compare two companies. Company A is our turnaround value trap. It's a struggling manufacturer in a tough industry. It has a low ROE of 2%, meaning it generates just 2 cents of profit each year for every dollar of shareholder equity. Because it's a terrible business, the market prices it as such, and it trades at a, quote, cheap price of 50% of its book value. Company B is our wonderful business. It's a dominant brand with a wide moat. It has a consistently high ROE of 20%. Because it's such a great business, the market recognizes its quality, and it trades at a premium price of 3 times its book value. An investor in Company A feels clever. They bought $1's worth of assets for 50 cents. An investor in Company B feels like they may have overpaid. Now, let's run the numbers for 20 years. The investor in Company A sees their capital grow at a pathetic rate. The business is barely creating any new value, so even though they bought it cheap, their wealth stagnates. The investor in Company B, however, experiences an explosion of wealth. The business is a compounding machine, retaining its earnings and reinvesting them at a high rate of 20% year after year. The underlying value of the business grows exponentially, and the stock price follows. After 2 decades, the premium price paid by the investor in Company B is revealed to have been the true bargain, while the cheap price paid by the investor in Company A is revealed to have been the trap. This simple example proves the most important lesson in long-term investing. The quality of the business is a far more powerful driver of future returns than the lowness of the initial valuation multiple. Your ultimate success is determined not by how cheap you buy, but by how well the underlying business performs over the time you own it. This is the final promise. It is the key to shifting your focus from the flickering prices on a screen to the enduring value of a great enterprise, the only reliable path to building lasting wealth and achieving true financial freedom. You have just navigated a fundamental shift in perspective. You have absorbed the critical distinction that separates the speculator from the true capital allocator, the amateur from the professional. You now possess the mental framework to differentiate between the siren song of statistical cheapness and the deep, resonant value of business quality. You understand why Warren Buffett's greatest evolution was his journey away from the cigar butts of his youth towards the invincible castles of his maturity. This knowledge is not just theory. It is a powerful tool, a lens through which you can now view every investment decision, protecting you from the market's most seductive traps. But a tool, no matter how powerful, is only as effective as the hand that wields it. Understanding the strategy, knowing what makes a wonderful business, is the first half of the equation. The second, and arguably more difficult part, is cultivating the temperament to execute that strategy flawlessly over a lifetime. Buffett himself has stated that the most important quality for an investor is temperament, not intellect. It is the ability to remain rational when everyone around you is succumbing to greed or fear. It is the psychological fortitude required to hold your wonderful businesses through the gut-wrenching volatility of bear markets, and the discipline to not chase speculative fads during euphoric bubbles. Knowing the path is one thing. Having the emotional stability to stay on it is another entirely. The video that YouTube is showing you on the screen right now is the bridge across that gap. It is the missing link between knowing the map and successfully completing the journey. Think of the knowledge you've just gained as a high-performance engine. The principles discussed in that next video are the high-octane fuel required to make it run. It decodes the mental operating system, the psychological architecture required to think in decades, not days. It is the key to acting with courage when others are paralyzed by fear, and with prudence when others are blinded by greed. It is the next piece of the puzzle, the link that connects sound strategy to unwavering execution. The choice you face now is not simply whether to watch another video. It is a decision about the kind of investor you intend to become. You can remain a collector of interesting ideas, or you can become an architect of your own financial destiny. You have built the foundation. The video waiting for you contains the framework for the skyscraper. Do not let your journey end here. Continue your ascent. Complete your mental arsenal. Your path to becoming a truly intelligent investor, the one who not only understands the principles but embodies the temperament, continues with your very next click.